Hey, econ students. This is our next lesson in AP macroeconomics for students who are learning in a period of epidemic isolation. This is going to be our last lesson on T-charts, and we're covering banking and T-charts today. This is all going to be really important for understanding and making calculations related to monetary policy. We're going to start today with a quick review of T-charts, and we're going to apply T-charts to the banking sector. So if you remember, in a typical T-chart, we're going to go assets on the left. And in general, we want to make sure that our assets are bigger than our liabilities. Oops, liabilities has an L in it. Let's try this again. But while we had assets and liabilities for you and I, in a way that I think was very easy to understand, when we take a look at a bank's assets and liabilities, I feel like a lot of students look at things backwards. And so we're going to just take a quick moment. You might even want to pause the video and consider for each of these lines whether these would be a liability or an asset for a bank. I'll read through them and just check for yourself. What do you expect these to be? Checking deposits, savings deposits, car loans, mortgages, securities. Securities are also known as bonds. Reserves, loans from the Fed, and loans from other banks. Let's do it. Checking deposits. I know a lot of students want to see checking deposits as an asset because that's money that the bank has. However, that's actually money that has to be paid back to the customer. We should see checking deposits almost as a loan from the bank's customers. And because that is money that has to be paid back to people, a checking deposit is actually a liability. A savings deposit, same deal, liability. A car loan, when we're looking at individuals like you and I, we see a car loan as a liability because we have to pay it back. But for a bank, since the bank has lent that money out and that money is coming back to the bank, having a car loan is actually an asset for the bank. Same thing with mortgages. Securities, for both individuals like us and for banks, these would be an asset. The reserve, just like our savings, is an asset. Loans from the Fed that has to be paid back to the Fed, that would be a liability, and loans from other banks are also a liability. So in our banking T-chart, under assets and liabilities, liabilities will be things like deposits from customers, loans from the Fed, and loans from other banks. Meanwhile, the assets would be mortgages, car loans, bonds. If it's our local town bank, there's a lot of regulations on what kinds of bonds they might buy. So T-bonds, that is treasury bonds from our government, might be the most commonly held bonds, and reserves. Something like this. Now, when it comes to monetary policy and the Fed can do several different things to mess with banking T-charts in order to increase the money supply, in order to increase the circulation of money, and all of that would be done to stimulate the economy when the economy is weak, or to slow down the economy if we're in a superheated economy. We need to know some of the most common policies taken by the Fed. And so we're going to put in Fed policies right here. Fed policies include, number one, the discount rate. Or when you're reading, sometimes you'll read about the discount window. The discount rate would be the interest rate that the Fed charges for banks when banks take out loans from the Fed. So the Fed is considered like the lender of last resort. If a bank needs to borrow money, they can go to the Fed and borrow money directly from the Fed. If we're in a time period where we're entering recession, if we were to decrease the interest rate from the Fed, We should see more banks taking out loans from the Fed to take advantage of those low interest rates. And then when we're looking at things like mortgages and car loans, we should see an increase. We should see a decrease also in those interest rates. And as those interest rates decrease, we should see an increase in lending in mortgages and car loans. And all of that then enters circular flow and goes around and starts producing more and more economic activity. Or the flip side would be if they increase the discount rate, that would discourage banks from borrowing money from the Fed. And if they do that, they should then be passing on higher interest rates to their customers, and so they would have less new lending in mortgages and car loans. We call the Fed the lender of last resort because generally banks don't like to borrow from the Fed. Borrowing from the Fed means you're dealing with a government agency. And if you're dealing with government, you're dealing with tons of bureaucracy and regulations and paperwork. And so in reality, most of the time, if a bank needs to borrow money, they end up borrowing money from other banks. And when they borrow money from other banks, they are borrowing according to the federal funds rate. That name doesn't make any sense. The federal funds rate makes it sound like they're borrowing from the Fed. If I was in charge of the world, I would rename the federal funds rate like the bank-to-bank rate, or something that actually makes sense. But the federal funds rate is the rate that banks charge each other for loans. And the federal funds rate tends to be just a hair above the discount rate. So if we had a hypothetical discount rate of like 1% today, we would expect the federal funds rate to be like 1.1%. If the discount rate goes up, the federal funds rate will go up. If the discount rate goes down, the federal funds rate goes down. And this is basically like a gentleman's agreement between all of the banks in the country to charge each other a rate that's just above the discount rate. And generally, banks will borrow from each other if they can because there's less paperwork involved and there's less regulation involved. And it's just much easier than dealing with a government agency. But for that convenience, they agree to charge each other just a tiny fraction of a percent more than what the government would charge them. So anyway, if we're looking at our economy, it's the same thing here. If we want to stimulate the economy, the Fed could drop the discount rate. And if they drop the discount rate, the federal funds rate will also drop. And if they do that, we should see increases in the money coming in from other banks. And as we end up with more money from other banks, we should see more lending to customers. Or the opposite would be true if we wanted to raise the discount rate and the federal funds rate. These two rates will basically go hand in hand. We've got two more to cover real quick. We have the reserve requirement, which actually does make sense based on this name. We have a fractional reserve banking system. So there are regulations telling banks how much money they have to hold in reserves. If they have deposits, they have to hold a certain percent in the bank, in the vault, or they can actually hold it at the Fed, and the Fed will pay them a little bit of interest on that. But they have to hold some of it in reserves. That way, when people come to take out their deposits, there is money available to be given back to those people. But they don't have to hold all of it in reserves. They hold just a small percentage of it in reserves. Meanwhile, the rest of it can be lent out in the form of mortgages and car loans and business loans, etc. So a typical reserve requirement might be something like 15%, meaning that if $100 were deposited, 15% would have to go into the vault, or would have to go to their savings account essentially at the Fed. Meanwhile, the other $85 could be lent back out in the form of mortgages, car loans, etc. If they were to change the reserve requirement from 15% to 10%, for example, then instead of having to hold $15 out of every 100, they would only have to hold 10 out of every 100. And in theory, that kind of change should increase the number of mortgages and car loans that are being made, which should stimulate the economy. Or the opposite would be true if we changed it from 15% to, let's say, 20%. That would require banks to hold more money in reserves. They could do less lending, and so that would slow down a superheated economy. The reserve requirement, just so you know, it is occasionally played with by the Fed, but the Fed tends not to mess with it too much because, as I've heard, that's kind of like trying to fix a light bulb with a sledgehammer. To change the reserve requirement is sort of painful for banks at times. If you were to raise the reserve requirement, you'd have to give banks, advance notice, and banks might be scrambling to make that actually work for their T-charts. So they try not to mess with that too much. And also in periods of recession, the Federal Reserve could lower the reserve requirement. They might drop it down to even just a single percent or something. But during periods of recession, banks tend to want to hold money out of fear, and people tend not to want to take out mortgages or car loans. So even if you were to drop the reserve requirement during periods of instability, you might not actually see the new lending that the Fed wants to see taking place. This brings us to our last and most important form of Federal Reserve policy when we're talking about monetary policy, and we're going to call this one open market operations, or sometimes it's just abbreviated as OMOs. And this is really all about the Federal Reserve buying and selling treasury bonds. So when we consider the Federal Reserve has huge volumes of money to play with. And the Federal Reserve has used that money over time to build up a huge quantity of treasury bonds, which they hold. If they want to, they can buy more treasury bonds or they can sell treasury bonds. And as they do that, that changes the way T-charts look for our commercial banks. Basically, if they wanted to stimulate the economy, this is going to sound backwards, but it's correct. If the Federal Reserve wants to stimulate the economy, they will buy treasury bonds. When they buy treasury bonds, then on a commercial bank's T-chart, if the Federal Reserve is buying treasury bonds, and they do this, by the way, by offering a really good rate for the treasury bond. Maybe it's a treasury bond that you're supposed to hold for 10 years. If you hold it for 10 years, you get 10% interest on it. But maybe the Federal Reserve will say to banks, hey, if any of you have a treasury bond out there and it's a 10-year bond and you've had it for 5 years, rather than holding it for the next 5 years, we'll pay you the full 10% return on it today. So anyway, they incentivize banks to sell treasury bonds sometimes. If the Federal Reserve buys treasury bonds and banks are selling their treasury bonds, then if we were to look at their T-chart, they end up with less treasury bonds and they end up with more cash. And as they have more cash, they initially have more reserves, but then some percentage of those reserves then become new lending in the form of new mortgages, new car loans, new business loans. So the Federal Reserve can stimulate the economy and increase the money supply by buying treasury bonds from banks. If the Federal Reserve wants to slow down the economy, if they want to decrease the money supply, then they can sell treasury bonds to banks. And again, they would do this by offering banks, really good rates on them. And if they did that, banks end up with more treasury bonds. And if they end up with more treasury bonds, then they must be giving up the opportunity to give out new mortgages or car loans. And so that would be a way of slowing down the economy. Any questions at this point? No? That's great. We're going to go to a calculation or two, and then we'll call it a day. When we're doing Federal Reserve policy, and especially open market operations, we're interested in how new money coming into the banking system is actually going to go around and around, sort of in the same way that circular flow worked a couple of videos ago. So let's imagine that the Federal Reserve uses open market operations to stimulate the economy. And let's say that they're starting with a small amount. Let's say that today they want to buy up $10 billion worth of treasury bonds. And so in various commercial banks' T-charts, we're going to see treasury bonds decreasing as $10 billion worth of treasury bonds are bought by the Federal Reserve. That will mean that initially the bank's reserves will be going up, and after their reserves go up, they will make new lending in the form of mortgages and car loans. Now, when they initially do this, the $10 billion is going to circulate a bunch of times. When it first goes into this system, let's say that they have a reserve requirement, an RR value, a reserve requirement value of 10%. And let's assume today that banks are not holding additional reserves. If they were holding additional reserves, then we would need to know what that number is. And instead of calling this the reserve requirement, we might just call it the reserve ratio. But the math is still going to be the same here. If initially we've got $10 billion coming into the banks, 10% ends up going into reserves, which means that reserves go up by 1 billion. As reserves go up by 1 billion, new lending goes up then by 9 billion. But here's the thing. That money has to go somewhere. As that 9 billion goes out into the world in the form of new mortgages or new car loans, there are auto salesmen who are being paid. There are construction workers who are being paid. As that happens, those people don't stuff that money under their mattress. They might spend some of it. They might put some of it in the bank. But whatever they spend eventually gets paid out to workers elsewhere in the economy, and they're going to spend it or put it in the bank. But eventually, if $9 billion in new lending took place, we're going to see $9 billion over here in new deposits in our commercial banks. But that means that when we have 9 billion coming in, 10% of that is going to go back into reserves. And so initially reserves went up by 1 billion, but now they're going to go up by 1 billion plus another 0.9 billion. And while new lending had initially gone up by 9 billion, now it's going to go up by 9 billion plus the additional 8.1 billion that is still left over. And that's going to lead to another 8.1 billion over here in new deposits. And that's going to lead to more reserves here and more lending again. And we're going to go around and around and around this system. This should remind you of what we're doing in circular flow problems. And the math for this is going to be really simple. When we were doing circular flow problems, we were doing things like, the total stimulus was equal to the initial stimulus times the multiplier. And the multiplier was, 1 over our marginal propensity to save. In banking, we're going to have almost the same math here. When we do banking, we're going to say that, our total money growth is equal to our initial change in money. I'm just going to put a change in M here for the change in money. And we're going to multiply that by the money multiplier. And the money multiplier is kind of like that 1 over the marginal propensity to save value. But in this case, we're talking about a bank's propensity to save in reserves. And so the money multiplier is equal to 1 over RR. Where RR is the reserve requirement, or it's the reserve ratio if banks are holding additional funds that they don't need to hold. So if we're doing this problem here, our total money growth would be 10 billion initially times 1 over 10%. But we should really write that 10% in decimal or fraction form. I like it in fraction form because if you've paid attention to our math classes, we know that 1 over 10 is equal to 10. And so our total growth in this case will be 10 times 10 billion, or $100 billion. So this problem tells us that if we want to expand the money supply by $100 billion, the Federal Reserve does not need to get $100 billion into banks' T-charts initially. They just need 10 billion. And if the reserve requirement is 10%, then that's going to grow as it flows through the system over and over again to $100 billion. We can do one other problem that's like this, and that would be a calculation dealing with new deposits. If people had been holding money like in their mattress or burying it in cans in the backyard or something like that, and they began making new deposits with that money, we would do the same math we just did here. We would just add in one more additional little piece, and that would be that we would subtract the initial change in money, the value of those deposits. So in the same case, if that 10 billion actually came from people's wallets or people's mattresses, then it would be 100 billion minus the initial 10 billion in deposits, because that money already existed. It existed somewhere. Whereas money coming from the Fed is really not like in existence until it comes into the bank. But this would be the same math. We just need to remember to subtract the initial deposits that came from people, because that money did exist. And so the total money growth is just a little bit lower if we're talking about money coming from people's deposits. That was monetary policy. Short and simple, I hope. We have more videos to come dealing with graphs that are involved in this unit. We have the money market graph. We have the loanable funds graph. We have the Phillips curve. Fortunately for this year's AP test, I understand we're not going to actually be drawing those graphs for credit, but I bet they're going to ask questions in such a way that we need to be able to understand what is in those graphs, the ideas that those graphs represent, in order to get to the right answers for the FRQs. So come back for at least one more video where we're going to be dealing with important graphs dealing with monetary policy.